Hello and welcome everybody to Finance 445. By now you've realized or recognized that there are only two participants in this class, so fairly small class. It was going to be a directed study with just one student. Now we at least have two so that you both can interact with each other. And as I mentioned to one of you on the board last week, I'll try to have enough posts on the board so that you can respond to my post as well, and that will count. In a small course like this, you don't need to be concerned with making sure that you're responding to somebody else's main post. You can respond and count as responses. Hopefully you had a decent first week. It looked like for both of you, we got some of the work in. It seems like one of you got most everything in and one of you is a little bit behind, but that's okay. We talked about last week how I do accept late work, not for 100% of the credit, but most of the credit. And so even if you find yourself behind at this point, it's not, I would never encourage you to give up or stop the course because you found yourself behind. You can easily catch back up. And even with a slight, just starting week 2. So don't get discouraged and just try to get caught up as fast as you can. Should have the grading done tomorrow. The school policy is that grading must be done by Wednesday at noon. I do usually like to wait and grade everything together so that I can make sure that I'm being equitable. If I grade on different days, I forget kind of the threshold that I wanted for. So having said all that, in a class like this, we'll have to see, depending on whether or not both of you get caught up and start turning things in at the same time, so I have both of you to grade, then I would wait. If I'm not going to have both of you to grade, then I'll get on top of your scoring a little bit sooner, and as you turn it in, type of thing. So, but anyway, you will have a grade by Wednesday at noon. I would expect that grade by tomorrow. If you've got any questions or concerns on that, let me know. Also, if you had any questions or concerns just from last week's work, the assignment, the assessment, anything like that, just zip me a quick email anytime, and I'll get back with you within a day. Phone is a little bit less easy for me to respond to because I have a day job where I can't sometimes answer the phone. I'm in and out of meetings throughout the day, and I'm not going to interrupt a financial plan. Sometimes at night and in the morning I can take calls, but the more consistent approach to get a response from me is just to simply zip me a quick email and allow me to respond that way. All right, so we got a couple of things that we want to accomplish tonight. The whole entire course to this point has been estate planning, and so I don't want to spend too much time on slides because you've got chapter 15 that you can only do so much studying on. This week, the biggest issue that we're going to take care of today and spend the most time on is actually as it pertains to your midterm. So your midterm is quite long, and we'll want to spend a good amount of time, maybe even as much as half the time tonight on the midterm, going through question by question, like we did last week, making sure you know the topics that will be on the test and kind of explaining through. Tonight we'll spend a little bit more time explaining through kind of the background on some of those questions so that you feel comfortable with what will be on the test and how to answer those. Now, having said that, the midterm is comprehensive, so many of the questions that you'll see this week are repeats from last week's test. So last week's test becomes more important based on the fact that it'll help your score this week. Last week's test was worth 50 points. This week's test is worth 100 points, so double the point total. Of course, still, in relative to things like the assignments each week that are worth 120 points, obviously you've got to make sure that you get those assignments in for those points, and make sure, obviously, and always be encouraging along the way that you get your checkpoints and discussion board comments in, just because those are the easiest points that you can achieve in a class like this. All right, and by the way, the discussion board last week was excellent. Thank you for 2 very good main posts. You'll both be pleased with your scores from those main posts. As long as we've got 2 other responses completed, you should both be in great shape. So I appreciate the participation on the board, and I'll look forward to this week's participation, again, about estate planning. All right, so tonight we're going to focus in and hone in a little bit more on gifts. And there are a couple very important things about gifting. First of all, many people have the misconception that when they give to their family, okay, or friends, or whoever they might give to, they are able to deduct that amount that they gift from their taxes. And there's some good reasons why that misconception exists. First of all, if you give to a qualified charity, okay, so if you give to a church, a college, some kind of not-for-profit charity that's a 501c3, which means it has that distinction given to it by the federal government, and it's authorized to take donations, and people are authorized to take a deduction when they give donations to that church, college, or charity of their choice. Now, there are some rules associated with that. Most charities, you can only deduct up to half your annual income. Some charities only up to 30% your annual income. Just depends on what the charity is. So you may want to check that if you're getting close to contributing more than half your income. or even more than a third, so you make sure you get the full deduction depending on how you do it. Obviously, there's some ways to split gifts between years and things like that so that you maximize your benefit if you're planning on making gifts to a charity. Okay, so back up. The reason I got off on that tangent about charitable giving is because that part of gifting is tax deductible. Gifting, as I mentioned earlier, to siblings, parents, non-family members, whoever it might be, individuals, okay, non-for-profit entities, so we're talking about individuals now, those types of gifts are not tax deductible. You do not get a tax benefit the year that you give those gifts to someone else, okay? What you do get, though, is a tax benefit. It's just not the kind of tax benefit that you might be thinking. So, for example, if I take some stock or appreciated property, let's say I have a piece of land that's now worth $1 million, and when I bought it, it was only $100,000. So I've got $900,000 worth of gains in this raw land that I picked up, let's say 20 years ago. And I'm worried about the fact that when I, am going to sell this property, that I'm going to have to pay a lot of taxes. A lot of people are concerned about taxes. And if you were to sell a property that's got $900,000 of gains, you're going to pay anywhere from $135,000 to $180,000 in taxes, okay? So as you can imagine, a lot of people don't want to write that check to the IRS. Well, there is an option. So first of all, we already talked about the fact that if you give that property to charity, okay, if you gifted that property to charity, and most charities will allow you to give them property, any kind of property in kind that then they then can turn around and sell it. If you were to do that, not only would you not have to count the gain, right, but you'd be able to deduct that full amount of value that you gave them up to the appraised value. When you give to family, friends, or individuals, so non-charity, you don't get that deduction as we've discussed, but you do get the benefit of not having sold the property and having to pay the taxes. And the individual who gets the property gets the advantage in most states of being able to assume that property, assume ownership of it, without paying a dime of tax, okay? Because most states don't have a gift or inheritance tax to the recipient, to the receiver, okay? Most states, it's about the giver, not the recipient. So let's explore this a little bit further. So let's say we have that same property. It's worth $1 million that I got for $100,000. And let's say I have 5 children, okay? And so what I end up doing is I end up deeding 1/5 of that property to each one of my children. And when I do that, okay, I relinquish my rights to that property, right? I can't be an Indian giver in this case, and pardon the poor taste of terminology that people have come up with, but Indian giving is just terminology and perhaps incorrectly labeled. It's giving where you then expect to be able to take something back after you give it. In the case of giving a gift, a financial gift, it's actually illegal to require that gift to be given back. And so in the case of me giving the 5 shares of my property to my children, or 20% to each child for the full $1 million in value, I get the benefit of being able to see them use that property and benefit from that property. I also get the benefit of not having ever written a check to the IRS, right? Because I didn't sell the property and just give them money, I don't have to write a check to the IRS. And the flip side is, if they go and sell the property, even a few days later, they get what's referred to as a step-up in basis. A step-up in basis just means that their basis in a property is whatever the fair market value was at the date that they received the gift or the inheritance. In the case of somebody dying, the date that you receive the inheritance is date of death, right? And that's the day that fair market value is assessed, and that's your new, in essence, purchase price, but we call it basis, okay? So in the case of my children, if each one of them is getting $200,000 worth of property, let's say one of them 3 months later goes to sell the property, they sell it for $210,000. Their basis was $200,000. They sold it for $210,000, so they end up paying $10,000 worth of. They don't pay $10,000 of taxes. I was about to misstate that. They pay taxes on $10,000 worth of gain. So they only held the property for 3 months, which means that they're going to pay short-term capital gains, which in essence is income tax rates. So if their income tax rate is 30% and they have $10,000 of gains, they're going to pay $3,000, right? But that's only $3,000 on $210,000 worth of property that they just sold, and they never paid for it. All they did was get the step-up in basis when their family gifted that property to them, okay? So are gifts to individuals tax deductible? No. Can they have tax benefit? Definitely. They can have tax benefit in the case where you give appreciated property, stock, land, any property that's appreciated over time. When you give that to family, friends, whomever you choose to give it to, you then do not ever realize the gain to have to pay taxes yourself. And that individual, in essence, doesn't have to pay the taxes on that gain either. They only have to pay on the gain from the time that they assume the property till the time they sell it, okay? So real estate and stock and mutual funds that are gifted, that are highly appreciated, that are gifted to family, gifted to charity, those are what we'd call highly tax efficient gifts, because the recipient gets a step up in basis, as we talked about, and the giver either gets a charitable deduction in the case of a charity, right, or non-for-profit, like we talked about, a 501c3 organization, and sometimes very effectively, they just accomplish a step up in basis on behalf of their children. They're able to give that property to their children. The children get a step up in basis, and they never pay tax on that gain, in essence, the difference between what they paid for it and what they gifted it at. Okay, can be a very effective way to give gifts to family that you're going to end up giving to them anyway in death. So let's say you have an orchard, and this is, done farming and had orchards for years and years and years in Utah County and Orem and Provo. There's lots of orchards here. So let's say Ivory Homes, which is one of the biggest contractors here, approaches mom, who is now a widow because her husband of 50 years has now passed away, and her sons are now taking over the orchard. But Ivory Homes comes to mom and says, hey, we'll pay you $20 million for your property. This is a great deal. This is the most that you're ever going to be able to get for a property like this. And everybody looks at each other in the family and says, you know what? It probably is time to sell the farm. Okay, sell the orchard. And mom says, oh, I just don't want to sell it because, this was Dad's dream. He loved it. This is his property. Instead of selling the property and paying taxes on most of the value, what she could do is first gift the property to her children, if that's what she intended to do anyway when she passed, allow them to decide whether or not to sell the property to Ivory or to hold out for another offer, or to farm that land themselves, their portion. And in doing so, she pays no taxes. The value of the property is transferred to the children, which was her intent anyway when she passed. And she doesn't have to worry about the tax liability associated with it. So people can make a grave mistake if they don't consider gifting in life, especially if they're intending for that money to go to their children anyway. And if you're sitting on a pile of cash, it really doesn't matter, because whether or not you give that in life or give that in death, it's the same value of a gift, right? And there was no tax on it anyway. If it was a taxable account, you've been paying tax as you go on the interest associated with that account. But if you've got highly appreciated property, once again, that's the key. Highly appreciated property, like stocks that have grown considerably, or land or property or homes or commercial buildings that have grown considerably in value, those are the kind of gifts that if you transfer those, incur a significant tax benefit, even if it's not tax deduction on your taxes. It's just the right to give that without having to pay taxes on that property that grew, okay? And the recipient, who in this case is your family, is able to receive that property without paying taxes and having a step up in basis from that point on, okay? So kind of a misnomer about gifting. Once again, give it to individuals, it's not tax deductible. Give to charities, it is tax deductible. Either way, if you're gifting highly appreciated property, it's a great tax benefit because you don't have to pay the taxes on the gain when you go to give, where you do always have to pay the taxes on the gain if you sell yourself, okay? So that's just an illustration of how gifting can work and some of the misconceptions about gifting. What is the requirement on gift reporting? A gift tax return, okay, a gift filing is with more than the annual exclusion in any calendar year away, okay? So let's say I have a son and I buy him a truck for $30,000, okay? And I don't expect him to pay back. We don't have a loan, anything like that. I just give him a truck for $30,000. In that year, I would be required by law to file a gift tax return and report the fact that I gave more than the annual exclusion that year. Now, remember, the annual exclusion is $14,000 per person in 2015, but we can do what's called gift splitting. Gift splitting is where a married couple, okay, will give $14,000 per person for a one-time gift, right? One gift of $28,000. And that one gift of $28,000 does not incur any penalties, taxes, fees, anything like that, because it's at or below the annual exclusion, which is $14,000 per person. So if I have a son, I want to give him a $30,000 vehicle. I don't have a choice tax return. Technically, I have to do a gift tax return because even if I'm married, the most I could give him here, right? So I can give him $28,000 this year. I can give him $28,000 next year. So a better way to maybe think of doing that, if I really wanted to give him a $30,000 truck, would be to pay for the truck myself, okay? And in essence, create a note between he and I until the first of the year that makes him pay a little bit of interest on the remaining balance, the residual balance of a couple $1,000s of a loan, so that I don't have to file a gift tax return. And then I can forgive the loan as of the first part of the next year because I can give another, $28,000 that year, and it'll only be a couple $1,000s. But anyway, there are ways, all I'm saying there are ways around having to file a gift tax return in splitting between years, changing the type of gift, creating a loan, and there's all kinds of ways around that. Having said all that, most CPAs would file a gift tax return and make it part of your overall package for maybe an extra $50 or $100. I mean, it's not a significant expense. It just can be a hassle, and so a lot of people try to avoid having to file a gift tax return where possible. So that's the requirement on gift reporting. If it's over $14,000 or $28,000 for a married couple in a gift to a single individual in a year, if you give more than that, you have to file a gift tax return so that the IRS can keep track of how much money you've given of your lifetime exclusion. Remember, your lifetime exclusion in life and in death is $5.43 million per person. And the IRS wants to know how much of that 5.43 you've used up before you pass away, because they want to know whether or not they need to create a calculation when you pass away so they can charge you that 40% inheritance tax, or the technical term is estate tax, not inheritance tax, okay? So the IRS is keeping track throughout your life as you file gift tax returns and totaling that amount, because they know of your life and death, you get $5.4 million, $3 million, and they're going to subtract whatever you've given above $14,000 in any given year, or 28 as a couple, from that number, okay, so that they know what you have left. So they can eventually tax you at 40% if they're lucky, right? Okay, so requirement is above 14, you gotta file a gift tax return. Why do you have to do that? We just talked about it. It's because the IRS wants to keep an accounting of that and get as much as they can of that gift, or that estate tax that's due if you give more than that 5.43 per person. Some limitations on it. We talked about how $14,000 is the cap each year. $28,000 for a couple if they gift split and use gift splitting. What another way around, though, the gift tax is that if you have a son or daughter that's married, right, or a son or daughter that's married with children even, you then have the ability to gift to each one of those individuals technically $14,000 per person. So if I'm married, I can give $28,000 to my son, I can give $28,000 to my daughter-in-law, I can give $28,000 to each one of their children here. But you'd be surprised how many affluent clients I come across that still have a challenge with this, because in one year they want to buy a boat or a car or something like that for them, or in one year they want to give them $100,000 because they sold a property and they feel like they deserve it. I mean, there's all kinds of different things. I mean, this isn't the world I live in. I'm not trying to give hundreds of thousands of dollars to my children at this point, but you'd be surprised how many of wealthy folks out there are trying to give as much as they possibly can to their children in life so that their children can use it in life. And that's a great aspiration. The challenge that they run up against is this gift tax situation, where if you give above that 5.43, you're going to get 40% tax rate. And if you give above 14,000, you're going to have to file a gift tax return, which most people try to avoid. All right, so one of the things that I think is important to consider is the value beyond money, okay, beyond the financial sign issue associated with lifetime gifts, or lifetime giving as it's called. Now, historically, and I think we mentioned this last week, giving in life had its own maximum, and then giving in death had its own maximum as far as the amount you could give before taxes. Now it's all combined. That's that 5.43 million number that we keep talking about. So that combined number puts less pressure on lifetime gifting, okay? Even as recent as 5 or 6 years ago, if you didn't make lifetime gifts, you gave up a huge, opportunity to give away money without being taxed. Now, since it all counts towards the same number, it really doesn't matter from a tax planning standpoint whether or not you do it now or later. If you're above that 14,000, if you're below that, it's a phenomenal opportunity to slowly gift away your estate and never incur taxation. Okay, so let's say a couple has $12 million of net worth. They know that they only have about $10.8 million between the two of them in lifetime gifts, in life or in death, that they can give to their children without a 40% tax rate. So they've got a couple options. Either they can give the difference away to charity, and then they won't have to pay any tax, or instead of doing that, if they've got another 5, 10, 15 years to live, they could aggressively give $28,000 to each one of their kids each year. And in essence, spend down, or give down some of their estate so that they don't run into that situation where a few $100,000 of their money is taxed at 40%, writing a big check when they pass away to the IRS. Okay? So lifetime giving can be for tax reasons, but perhaps the most important consideration for lifetime giving now that we have this life and death maximum instead of a life one and a death one separately, perhaps the biggest issue now has more to do with what has always made sense to discuss with clients and people who are in this situation, which is, after you die, your children are going to split however you've dictated the money, and you don't get to enjoy during your life watching them benefit from your assets. So some people, up until they die almost, their children are struggling financially. They have medical bills and problems, and all kinds of different issues that come up. And if they don't if they don't give lifetime gifts, they don't get to see them try to benefit from that. The other thing that happens in many cases is, by the time somebody finally passes away and gives their estate to their children are in their 60s. Think about this for a minute. They're in their 60s or 70s. One of the most financially stable, and lucrative times of life, right? Incomes are the highest between 50 and 65. because we've got a lot of experience. We're most valuable that we've ever been in our career. And so at that point, we don't need the money nearly as much as we did maybe when we were starting our families or going back to school, like maybe you are. These kinds of things are very expensive and put a lot of financial strain and stress on families and on individuals. And so I just encourage all my clients and customers to think about gifting in life, be able to enjoy watching your children and grandchildren benefit from the funds that you have, the estate that you have, if you're able to. If your plan is to do that anyway, it's a uniquely good opportunity to take advantage of that during life. Okay, so there's a lot of psychological benefit that can occur through lifetime gifting, even beyond the tax benefits that are associated with it. Now, gifting can have two different issues when it comes to trusts. Okay, you've got revocable trusts and you've got irrevocable trusts. Okay, it's a kind of a nuanced issue, but revocable versus irrevocable. Revocable gifting would be a situation where I put money into a revocable family trust that says all my estate, all my house, my house is my property, my 401k, all my stuff, the cash in the bank, everything goes to my kids equally if something happens to me. That's a very common revocable family trust. Why is it revocable though? Because at any time I could go ahead and take that money out and use it for my own care, right? I could take that money out and use it for assisted living or go on a trip to Hawaii, or I could get remarried and spend it on a new spouse or something like that, make everybody mad in the family. So there's lots of different options that I have, but I've got full flexibility to use that money. So we call that an incomplete gift. It's not a completed gift, okay, when you have a revocable relationship with your gift. So even though in my trust it says that all my money is going to go to charity, if I put it in a revocable trust, just a regular family revocable trust, I have not completed the gift. And because I have not completed the gift, I don't get the tax benefit of completing the gift. So only completed gifts get the tax benefits from charitable giving. So you don't get that deduction if you don't have a completed gift. Even if you're earmarked, even if you've earmarked something for charity, if you haven't completed the gift by making it irrevocable, okay? So making that decision final where you cannot take that money back. Until you've done that, you don't get any kind of benefits from that gift, okay? Now, you keep control though, right? So basically it's a catch-22. You either lose control of the funds, which sometimes you do by design, and that's a good thing to do. You either lose control and get the tax benefit, or you don't get the tax benefit. Okay, so those are your options when it comes to gifting. You either make an irrevocable gift like a Uniform Trust to Minors Act, which is an UTMA account or an UGMA account. Those are gifts that are completed. So if I open an UTMA account through my bank and I put $10,000 in it, that's a gift that I've made to my child, and I then cannot retroactively take that back. Okay, that gift is done. It's complete. I can't take it back later. Now, I can use that UTMA account for the care of my child, the support of my child, for the college education, for marriage, for cars, for first home purchase, whatever I want, from that UTMA account. But I cannot use it for my own benefit from that point, because that's a completed gift, an irrevocable gift, when we're talking about UTMA accounts, which are common accounts that adults open for their children. Grandparents, parents will open for their kids, because it allows them to maintain control until the child is 18 or 21, depending on which state you live in. And at that point, the child can take over when they're a little bit more mature. Now, we all can look around at each other and say, okay, 18 or 21, that's a joke, right? Most of us aren't financially mature at all at 18 or 21, but that's just how the law is. And I guess it's better than giving them a chunk of money when they're 10 or when they're 8, right? Because it's more likely that they'll do something responsible at 18 or 21, like pay for school, buy a car, put a first home, down payment on a first home, something like that, than it is when they're 5 or 10 and can't even do stuff like that. Okay. So that's what UTMAs are. They're irrevocable trusts. But you can also just open an irrevocable trust with an attorney. You can start an irrevocable trust that in essence completes the gifting. So if I do an irrevocable trust and I put some life insurance in it, and I pay significant premiums for that life insurance premium is a completed gift. I can't change the benefit of that insurance at any point. It's irrevocable. So I do get the benefit of it being out of my estate when I pass away. Okay. One more quick thing I wanted to do before we move on to this is I wanted to share what I thought was an interesting, see if I can get to it. Okay, maybe even tonight if I'm lucky. Sorry about this delay. Had it pulled up, but screens tend to die on us after a while. Okay, if this pulls up today, what it was major error. CNN Money and MSN and education as it pertains to finances, estate planning. It's a very common topic, information out there. In a few seconds, and one of the first articles that came, major errors in estate planning, that we read about in chapter 15. So I had some slides, and then we need to turn, as I told you I would. So the first major mistake: don't even have a plan. And we talked about this last week. Plan, no will, no medical powers of attorney, no for those kinds of things, no guardianship. It's not just for someone who has a plan is the first major. Another mistake that is, so let's not take it too seriously, but enough people who use just online programs or do-it-yourself mistakes can be made when that happens. And we talked about in chapter 15 is that technically are the only ones that can write or things like that and make sure that they're legal. You, okay, in consultation, have confidence that at least the person's practicing law, planning as well. One of the things that I see commonly in my business is always keep in mind the fact that even if you have accounts, savings accounts, life insurance, and owned by the trust, and it doesn't matter if you're working that it actually precedence over what the trust says, that all my property gets account that has a payable on death beneficiary as my sister, because if I have one at that point to pay, my will and my trust dictate that all my property, because as I mentioned earlier, titling and beneficiaries on contractual property, okay. So be careful about that. Make sure that if the title to the trust, so a lot of people, it's common to change property to something that they have so that's owned by the trust. Then if they pass away, it just stays in the trust. People, after they write a trust or a will, just think in their mind that automatically takes care of and beneficiaries on most financial products, take precedence, will take precedence and will invalidate whatever your intention. Good estate planning attorneys will strongly encourage you to change the titling in a will and also change beneficiaries to the trust and things like that, so that the trust upon your passing and the trust will dictate where everything goes. Or not probate, like we talked about last time, how probate can come in and be private, not very costly, and can be very quick. Okay, so make sure that you understand gift and estate really help with that. Can help leverage your needed. Make 5.4, 5.12 back 2012. Now it's 14,000. Okay. In 2012, those exemptions, leaving assets outright to adult children, is it really the right thing to do to just leave a big body, create a legacy, or a better way to create value on their behalf? So just as an example, if they have an extra dollar to their names, they're going to go buy more drugs, okay? Because the likelihood of it going right, the person is not a drug addict, but just a bucket of cash, it's very unlikely that is box to this. Consider if you accomplish certain things, it releases money for your maintenance, basic education, for starting a business, for a new home purchase, for home money from a trust, instead of just handing them a bucket of money and expecting them. Of us would have a challenge taking a bucket of money and a very, very poor job when there's a windfall situation, managing our money. And point of studies that they've done on people who've won the lottery that are usually bankrupt just a few short years later, because they just don't know how to term. It helps them have a lot of fun for a short period of time, but it doesn't. When you're giving these to use trust planning to potentially create long-term. Okay. All right. So I just thought, very topical, something that you got different issues online regarding different estate planning issues. Okay. IRS and TurboTax would be interesting or helpful, but I think it's not necessarily easy to understand that information, but there's a lot of different write-ups about, the different laws. So if you have any questions, annual exclusion, gift can be things like information. It's not like you have to go to a CPA to get tax information. To understand is that once again, TurboTax and Tax Act and H&R Block can do a very good job of basic returns and some, for example. So just be aware of that. And if you're in a situation where you're gifting and needing to file a gift return, now, for most of us who are just, we're W-2 employees, we have a paycheck that we get a W-4 at the end of the year. Yeah, we can use TurboTax, we can use, corner tax place, whatever it is. We can even file straightforward. Tax law is when your situations like gifting, those kinds of things, like small business. I would put those all in a category of things that we do that then make hiring something they can find a lot of value for us and when we're situated. If you're doing lifetime gifts and you're gifting more than individuals and you need to do a gift tax return, I would strongly encourage you to involve some different techniques. We don't have a lot of time to cover these. Just remember, when you're thinking about estate planning, that we've got the situation, everything we own to our spouse, and there are no estate taxes or gift taxes no matter how much we give to our spouse, okay? So we talked about this last. If Bill were to pass away and give everything to his wife, somewhere around $50 billion, if he were to give $50 billion to his wife, there would be no taxes due. This is Melinda Gates, and she hasn't gotten remarried at the point. But if they weren't, she would pay 40% of the $50 billion of assets. So just as an example, just quick math, right? If they're worth $50 billion and she's going to pay 40%, $1 billion wire or check to the IRS, their estate would, before it got divided out between the kids, $30 billion worth of assets. But Bill and Melinda Gates are very, very smart. and so is Warren Buffett, Branson, you name the billionaire, and they're probably in a similar situation where they have strategically gifted paying taxes to their children, okay? And they're going to set their children up very, very well, obviously. We don't need to be gifted to charity. And you can gift billions of dollars, create a lot of good and legacy in the world. And that's Bill and Melinda Gates Foundation is going to be doing good things for the world for years and years. They're able to put into it and fund different projects and legacy issues and endowments for lifetime gifts. That's where you can get tax. Okay, it can transition between spouses without any gift taxes. Gift taxes do not apply for spousal. About that, we talked about charitable gifts and how our university that we attended as a charity, but both of those would be considered 501 context of giving. So if I give money to Brigham Young University, because that's where I went to school, if I give money to a church or college, I get a 50%. I get a total deduction on what I to my church. I get to write off $10,000 as a tax deduction that year, and it can significantly reduce my tax liability in that year. Okay, so that's just an example of charitable gifts. All right, they're concerned. Let me just double check. There's nothing more. Nope, we need to do exactly. Now, I am going to go, like I did last week, to my screen where what that means for you all is either that last slide that we were looking at, which either way is fine. By the way, just as a quick note, and I made a note to myself and forgot to mention it, but assignment. So I'd strongly encourage you to go check the wrong thing. Okay. All right. So let's get the test this week has 50 questions. They're all multiple choice. The good news is you've got extra time, so you've got 2 hours to do the test this week. And like I say, a large section of the test questions are repeats from last week's test. So because the midterm's comprehensive, and this seems to happen quite a bit in these finance courses, but because it's a midterm that's comprehensive, you're going to notice or see many of the same questions that you saw last week, especially early on in the test. Okay, so I'll kind of zip through this review. It's just meant to be an opportunity for you to take a few notes on things that will be on the test, so that as you read through and review Chapter 15 again this week, you'll feel comfortable that you are able to pick out the things that you need to remember, for the test this week. So number one on the test is just trying to help you understand what the main objectives of estate planning are. Okay, and it's not rocket science. This is not a hard question. It's going to give you a frivolous objective, and you just need to identify that objective as frivolous. If you can't, it means we don't know what the main objectives were, and we should get that problem wrong. So just make sure you understand the main objectives of estate planning and be able to identify them. Another repeat question from last week is, what is estate planning like? Is it like retirement planning or insurance planning or investment planning or tax planning? What are the two, of those things I just mentioned, what does the book say estate planning is most similar to? That'll get you one right on the test. Once again, another question about the goals and objectives of estate planning, similar to, it's actually the same question we had last week on that topic. So if you understand what the main goals or objectives of estate planning are, you'll get that one right. Number 4, same thing, objectives of estate planning. Number 5 and 6 are repeat questions about first level and second level death-related costs. Make sure you can differentiate different costs that are associated with first level and second level death-related costs. Make sure you understand how often the book tells us that we need to review our estate plans. Obviously, we could review them more often, but what does the book suggest as far as how often we should review our estate planning? Make sure you understand what the definition of a probate estate is. You're going to see that terminology a few different times, a probate estate within the test. So make sure you've refreshed on that from last week. Make sure you understand why, beyond that 3 to 5 year timetable where we should at least review that often, but why are some of the reasons why we might review more often? What are some life events that might create changes in our estate planning? And then be able to identify maybe events that are not life-changing events as far as estate planning is concerned. So just as an example, I could break my leg and that could be a life-changing event for me, but it probably doesn't change my estate planning. Okay. If I have a child this year, okay, if I have a new baby, that's a life event that probably does change my estate planning, right? So anyway, just some different examples of things that do or don't change your estate planning. Let's see. Want to make sure some of the issues and problems with estate planning, some of the we read this article, the 7 things that people get wrong. The book goes over quite a few different things in chapter 15 as far as what can be problems of estate planning. And so I just encourage you to review those because you'll be identifying a few of them on the test. Number 11 on the test, let's see. You want to understand what the book has to say about people planning and things planning, okay? So there were asset planning and people planning, and they were different, and what does the book have to say about that? Let's see. Different problems of estate planning, again, for number 12. Number 13, we talked about UTMA accounts tonight. That's an example of a custodial account. Make sure you understand basically what custodial accounts are and how they work. Number 14 on the test is another question that asks about first and second level estate or death-related costs, excuse me. So first level, second level death-related costs. You want to know the differences between those and some examples in each. You want to understand what an estate breakup is, what it entails, why we call it that. Number 16 on the test, we want to understand the uses of life insurance. We've talked about it, but make sure you understand what the book talks about as far as why people use life insurance when it comes to their estate planning. Number 17 is another question about probate estate. Number 18 talks about, it's a repeat question from last week about complexity of estate planning and whether or not having property in different states either enhances that complexity or reduces that complexity. Pretty straightforward, logical answer to this question. So don't second guess yourself. Do you think that having property in multiple states would add complexity, or would it reduce complexity to have different property in different states? Number 19, talking about storing important documents and whether or not that's an important aspect of estate planning or not. So make sure you understand that before you get to the test. I think another repeat question. Number 20 is how trusts help with asset transfer. Okay, so once again, going back to the pros and cons of a trust and whether or not what the main objectives of a trust are, and you'll get that one right. Make sure you understand how inflation can cause problems for estates. So what can inflation do to estates? What does the book have to say about that? Make sure you understand whether or not life insurance is usually adding to or taking away from probate estates. So does life insurance usually end up in probate or not? Okay. Number 23, estate taxes, are they levied against the person who died, their estate, or are they levied on the individuals that have property transferred to them? Okay. And then what value is used? Is the value date of death or 6 months later, or is it just the value that they purchased it at? How do they determine the value of property that's going to be transferred to heirs? And we've talked about that a little bit tonight. It gets that transfer, it gets that step up in basis, it gets fair market value as of date of death, right? Make sure you understand what an irrevocable life insurance trust is, or an ILIT, what we call an ILIT. What is it? How is it used? Make sure you understand what a will is for. Okay, what are the objectives of a will? Why do we have them? Make sure you understand the different aspects of disposition of property. So the whole idea of estate planning is that at some point in an orderly way, and according to the objectives of the individual who created the estate plan, their assets are going to be disposed of, right? Make sure and understand what the book has to say about the ways that an estate can be disposed of. Okay, and I say disposed, that doesn't mean thrown away, right? That means it's liquidated, right? It's ended. It's disposed of, but it's disposed in the way, that the estate is supposed to be disposed of to the heirs or charity or whatever the objectives were of the person, of the deceased. Make sure you understand what sections are included in the last will and testament, and in that way you'll be able to also see which ones are not, right? So the test is going to ask you, okay, identify something that's not part of the last will and testament, and you're going to want to be able to identify that by knowing what is part, right? You're going to want to know what it's called when you die without a will. What is it called when you die without a will? There's a terminology for that when it comes to estate planning. So if you have no will and you die, what is that called? Okay. And make sure you understand how probate will treat your situation. We talked about this last week. Probate will have the bulk of your assets go to your spouse, and then the residual amount to your children, and then a residual amount to next of kin if neither of those exists. If you have a spouse and children, your spouse will usually get 50%, your children will split the other 50. What we talked about last time is sometimes that's not your intended objective with your assets. Some people, especially in second and third and fourth marriages, want all their assets to go to their children, not to their spouse. Okay, that might sound bad, but that's very common. If you don't have a title correct, or a beneficiary correct, or a trust correct, okay, or a will in the right way, then probate's going to decide that your spouse is going to get most of what you have. Let's see. You want to make sure you understand how probate is going to pay out, like we just barely talked about. Exactly what we just barely talked about. Number 31 on the test, you want to know what it's called when you have listed somebody to take care of your children. What's that called? Number 32 on the test, you'll want to understand what the book has to say as far as the requirements for a valid will. Okay, what's required? Make sure you understand why we choose who we choose for guardianship. Okay, there was that blip we looked at, a slide we looked at last week, but it's just it's a page in chapter 15 that talks about how you decide about guardianship. Make sure you understand the different terms associated with the trust or will. So you've got attorneys, you've got estate planners, you've got grantors, you've got testators, you've got trustees, you've got executors, you've got personal representatives. You need to know for 34 and 35 who all those individuals are and what their role is. You might know some of them, but make sure and just brief up on who's who before you get to the test. Make sure you understand, as we've talked about earlier, that an attorney does not have to write your will. Even though we talked and talked and talked in this class about how, and the book talks about how, we strongly encourage you to have an estate planning attorney be the one to draw up a will. Most states don't require you to even have anything beyond just something that you handwrite. If it can be deemed valid, then they'll respect it. Some states require witnesses to that, but courts will, in most cases, try to follow your intentions, even if your intentions weren't drawn up by an attorney. Attorney just can help us make sure that we've got it right and don't make mistakes in what we're doing. Number 37. So the issue of mental competency comes into play when somebody writes up a will or a trust. They must be deemed mentally competent at the time that they created their will or trust. However, the beneficiaries of the will or trust don't have to ever be deemed competent for them to be beneficiaries. Okay, so just keep that in mind. Number 38 talks about testators and what they do. Make sure you understand that. Number 39 is a letter of last instruction. What might be included in that? Make sure you understand what might be included. That's 39 and 40. So letters of last instruction. See what the book has to say about that. Make sure you understand, once again, we talked about this earlier, the different people involved in your trust. You've got trustees, grantors, executors, personal representatives, attorneys, tax accountants, administrators, life insurance companies. You got all these different players that can be associated with, what happens when an estate gets liquidated or disposed of, and we need to know the role of each one of those. Make sure you understand the difference between your gross estate and your net estate when it comes to estate taxes. Okay, what is your gross estate? What does that mean? Okay, so 42 through 44 on the test are all about gross estate. So make sure that you've got kind of the general idea on what a gross estate is and why we care what a gross estate is. Number 45 on the test just talks about regular updating of a trust and how important that is. Regular updating of an estate plan, of course, we know that's important. Number 46 is another one about life events that would cause us to update our will or trust. Pretty easy one on number 46. Number 47, what does it mean to die intestate? What does it mean to die intestate? Intestate, okay. And then let's see, a good estate plan. What's the definition of a good estate plan according to the book? Make sure you understand whether or not a will is legally required of every single individual or not. The book does have something to say on that. And make sure you know on number 50 what intestacy is. Okay, intestacy. All right, that's the test this week. If you got any questions or concerns about this when you're listening to it later, let me know. But we should be in good shape. like I say, a lot of those are repeat questions from last week. So just re-review chapter 15, dig into it, go through some of the details that I've mentioned to you. We'll be on the test, and good luck this week on it. Hopefully we'll see all your work in this week for both of you, and look to see your grades over the next day or so that you'll get your feedback. Have a great week, and we'll talk to you later. Good evening.